The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Lex Sokolin, head of Autonomous Next, the disruptive technologies arm of research firm Autonomous. Topics of conversation today include Amazon versus Google versus Facebook for financial services disruption, the shortcomings of open banking, and what the past few months in crypto tell us about what's next. In the conversation, we make reference to the newsletter Lex writes and to his recently published crypto report, both of which you can find at next.autonomous.com. Let us know what you think of today's episode at Rebank Podcast on Twitter or in the comments section on the website. Thank you very much for joining us today. Please welcome Lex Sokolin. Lex Sokolin, welcome to Rebank.
Wonderful to be here.
Well, it's good to connect again. It's been a few months, I think.
Give or take, at least on the air.
Yeah. So I think it was, we were talking about AI and the impact on society last time we connected.
Yes, I was starting my tinfoil hat business.
I think as you rightly said, this is the first time in a few months we connected on the air. I feel like we touch base at least weekly because I'm a very happy subscriber of your newsletter. And I thought we might start by picking up a few of the recent topics that you've covered there. So there was one, I don't remember if it was this past week or the week before, which was around, I think the title was Why Amazon Beats Google for Insurance Aggregation. And you've written on a few things related to kind of big tech in fintech lately, and we can probably expand it out as we go. But specifically, what was that piece about? Why Amazon beats Google for insurance aggregation?
Sure, absolutely. So one of the things that people are nervous about and have anxiety, and by people I mean people that run large financial institutions, is the idea that the faster, nimbler, well-capitalized tech firms are going to come in and eat their lunch. And that lunch is either deposit products if you're a bank, it's investment products if you are a BlackRock or a Vanguard, and it's insurance products if you're Aviva. And so recently there was an announcement that Amazon was going to start an insurance comparison site in the UK. Now, a lot of, I think, insurance stocks fell in fear of Amazon doing this the same way that after they got into food retail, all the food stocks went down. And people started thinking about it, and the first reaction was, well, actually, Google tried this a while back. And Google tried not in insurance, but across different products for comparison shopping financial services. So whether it's banking accounts or mortgage rates or whatever it is, you would go to Google and you would search for something, and kind of like Travelocity, you would get the best result. And so when the Google version of this had come out earlier, people were afraid that it would essentially steal traffic from the underlying financial services provider. And that did not happen. For many financial products, Google went back with their tail behind their legs, both in terms of the wallet, and Google Finance is all messed up now. And so a lot of these entries into finance didn't work out. So people said, let's not worry about Amazon because it didn't work for Google. So the entry was all about why that's wrong, why in fact, Amazon would think quite differently about the world, and why it's positioned in a much better way to actually pull customers and make them interested in this stuff.
And that was in part because they have more experience kind of working with product manufacturers and sellers, and it's about distribution, and it's about access, and about understanding needs both on the manufacturer side and the consumer side.
So part of it is definitely the network you're talking about. Amazon knows, for example, how to do payments. They've had their own rails, certainly internationally, for enabling payments, and they do this not because they care at all about payments, but because they can get people to shop for Amazon stuff, right? End of the day, they have a really nice business because it's a platform, which means they don't really care what they sell. They don't really care who buys stuff and who sells stuff. What they care about is that it happens in their marketplace. So every single feature they add to the marketplace makes it a better place for economic activity, right? So you enable payments so people can pay you if they're unbanked. Similarly, they do merchant lending, right? So if you're a merchant on Amazon and you want to sell a bunch of your stuff, you could get a loan from Amazon, and Amazon knows you really well. It knows your cash flows, it knows your traffic, it knows lots of things about you that a bank does not. And so again, there's kind of this existential threat, but Amazon doesn't care about the lending. What they care is about helping merchants sell more stuff to other people on their platform, right? So this is 1 out of 1,000 features to make that commerce better and easier and stickier. So that's definitely a piece of it. But I think the comparison to Google falls apart on an even more fundamental basis, which is the following, right? So when the news came out, sites like Go Compare or Money Supermarket, those were the ones that are most affected. And for those of you that are in the U.S., where I don't think have a really good equivalent, maybe Lending Tree. So it's a place where you go and comparison shop for a credit card or an investment product or a mortgage. And so those sites would be the most impacted, and they're lead gen sites. So the way they work is that they sell the leads, the people who want to buy that investment product or insurance products. They sell the leads to the manufacturers, which is the financial services industry. And they get the audience from the search engines, SEO, content marketing, right? So they bridge the gap between audience that has an intent and then a lead that's really ready to pull the trigger on a specific thing. So when Google goes into this business, they're essentially competing with the people who would buy advertising from them, right? So if I'm Google and under my search bar, I put in, here's the prices of all the insurance stuff, or here's the prices of all the mortgages. What I'm doing is I'm fighting a lead generator who would otherwise pay me $5 a click on CPM or whatever it is, right? So by building that business, I have an opportunity cost, and my opportunity cost is against somebody whose sole reason for living is to convert leads into insurance product, which is how exciting that is as a career choice. So the people who are doing it are really good at it. They have to be. That's what they're focused on. And Google has this opportunity cost where they would, by competing with these guys, they would shoot themselves in the foot. Amazon is not an audience building business. They're not in a place where they're giving away free product and then they're selling advertising against it. Amazon is in the business of getting people to buy stuff, and everyone is already a customer. So plugging in comparison shopping inside of Amazon is a much, much stronger play. It's like if you think about Apple and iTunes, Apple didn't have to sell advertising for music. They could just strong arm the music labels into bad deals so that Apple could sell iPhones. And Amazon is pretty much in the same position because they actually own an asset that makes sense.
So I guess, stepping back a little bit and thinking a bit more broadly about big tech in financial services, there's this been kind of this ongoing conversation for the past few years now about how, is or isn't GAFA going to storm financial services and make banks irrelevant? And I think the very obvious takeaway from your piece and from this conversation is that you have to look a bit more granularly than that and think about which businesses can profit from which business models intermediating or manufacturing which specific types of products. And whereas Amazon, you mentioned the payments, the merchant lending, and now the insurance piece may be well positioned there. Other companies, Facebook comes to mind, might have different priorities. And there was a news article out recently which caused a bit of a stir about Facebook approaching the biggest U.S. banks, effectively asking for permission to tap customer details and start to network user profiles against account information in order to facilitate payments. You wrote about that one too. I think you called it a Faustian bargain offered by Facebook to the banks. Would be interested to hear your thoughts there.
I think it's important in life to seek alliteration whenever you can. So thus the Facebook Faustian bargain. The thing about the business models that you said is exactly on point, right? Technology is like water. It's going to flow everywhere that it can, and it's going to erode all the edges that it's able to erode, and then it will bump up against regulation or consumer preferences and stop there. So for Amazon to flow as far as it can into making its platform better, that makes sense. For Amazon to say, we want to launch an investment fund, doesn't, at least today, doesn't really make sense. If you look at Facebook, it's a totally different animal, and its asset is user data. The core of Facebook is us, all of us. The things we say, the things we let Facebook do, everything we plug into Facebook so that it knows how much we post stories on Instagram and what we supposedly say in secret on WhatsApp. Those are the assets of Facebook, which has to monetize that. It can't monetize anything else. So it was almost kind of a comical blunder that this came out in the news where at a moment where I say Facebook, you say Cambridge Analytica and Trump, at this moment when it's at most heavy criticism is going on, they are in the news for, hello, JP Morgan, could we please have all your customer data? We promise we won't sell it. It's just sort of, I'm sure that that's not how it was meant to come out, but that is how it hit the media. And the use case makes sense. So here's the use case. Here's what they wanted to do. They wanted to say, listen, you have customers who probably don't really engage with you, or you're about to hit them with a fee. Why don't we just pull that data in through Facebook Messenger, which is where your customer lives? So if your customer is in the Messenger stream texting and something's about to go on, like fraud or a purchase that needs to be authorized or an overdraft, whatever it is, we just ping them through Messenger and win-win. You get to have direct engagement, and then we enrich the experience of Messenger. And there's also the related stuff around chatbots and virtual assistants and things like that. But of course, that's like, you could not have more of a Trojan horse. Just give us the thing that's valuable and put it into our house, into our safe, and we'll lock it for you, right? That's the offer. And so there's quite a bit of pushback around it. And I definitely think that the pushback is warranted, especially because they wanted that stuff for free. Otherwise, they wouldn't ask, because you don't need to ask to get it. You can just pay for it. There's a ton of data aggregation companies in the United States, Yodlee, Quovo, Plaid, a whole bunch of stuff. You can go and integrate into them, and then your customers, your users, would be able to authenticate you into their bank account. In Europe, you have PSD2, so you could go and you could build into the APIs that are already available. So it really seemed kind of like PR blunder, showing their hand in a quite weird way. The other thing, just as a leading idea, Facebook is in a lot of this stuff. So blockchain, crypto, they're playing in that as well. So they can't really be ignored. But I do wonder what their collective strategy is.
We actually had, you and I, an exchange on the back of that piece around the, okay, so in the U.S., why don't they just pay for that? And I think you made the good point in the write-up, little back of the envelope math that something like, I can't remember, it was 40 cents a customer or something. It was going to cost them billions of dollars to access this.
It would actually cost them the market price of this would be at least $1 billion.
Good reason to go ask for it for free. So in Europe, okay, open banking, PSD2, why don't they just go out and grab it? And I suppose not knowing precisely the answer, my hunch is that despite all the press and PR and publicity around open APIs, open data, access to information across Europe, the fact is we're just not even close to the point when you can actually collect at scale the data that you'd be interested in. And even when you can, I think the richness of these APIs that are currently being developed and offered, both by banks that are required by law to offer them and by others, including many forward-thinking fintechs, the richness just isn't there. Often it's read-only, which really prevents a lot of those kind of seamless, integrated, cross-interface, cross-platform experiences that people have been talking about and anticipating.
Yeah, I mean, this is a huge frustration of mine in a prior life, building out digital wealth, which connects into financial planning and net worth statements and aggregation. And I really do think that read-only is it's really a tombstone for a lot of fintech. And the reason is the following. I'm not sure if we talked about this before. It might sound depressing, but it's comes from a little bit of scar tissue trying to do this. I think at the core, people hate financial products. So I don't mean they're frustrated with banks or there's too much paperwork. I think generally speaking, people struggle with their finances. Finances make them feel bad. Telling somebody you're not going to retire with any money left in your pocket is more of a stressful situation than call it, sharing pictures of kittens on Reddit. So the Reddit app is viral and it has positive utility. And for most people, financial products really hurt to interact with. Outside of even UI and UX, right? It just in terms of the social environment. And so when you design fintech apps, the last thing you want to do is give people finance homework. So finance homework comes in a number of different permutations. One is, here's a website, fill it out to get approved for a mortgage. Or here, our employer picked a new 401k provider, choose your allocation, right? That's finance homework. So many fintech companies went one step up from that and said, listen, we'll do your data aggregation. We'll plug it in from either screen scraping or APIs and even forget all the issues about the quality of the data, but we'll pull it together, right? So we'll do your financial plan, we'll do your net worth statement, we'll tell you how you're allocated. All that homework we'll do. And that's happened about 8 years ago. And once you do that homework, you're still left with the same problem that now somebody who had to fill out the spreadsheet is sitting there with a completed spreadsheet feeling like their life is tough. It's still, they have to take the action and do the next step of engaging or converting or figuring out what the problem is, which is why what you really need isn't information, you need action. You need automated action, which is why things like Acorns in the US have done a spectacular job, right? Stash, Digit, things that are little automated investment or savings agents that go and do things for you. The best interest rate, turn off your subscriptions, whatever it is. Kind of the job, the boring job of the financial advisor or planner at that very low level. And so if you don't have APIs that let you open accounts, that don't let you move money, that don't let you trade, that don't let you prepay, all the things that need to be programmed around a financial product, you can't build the agent. And if you can't build the agent, you are stuck between the bank and their customer and how they're used to interacting.
Do you see that changing?
I would turn that question back around to you. Whose fault is it? I think I do think there are a number of incumbents who are very motivated to change it, and that have been industry leading in trying to say, we're going to do a new digital bank from scratch, right? And so the usual examples are BBVA, Santander, and of course the Nordic banks are very, very digital. Almost nobody goes into a branch or banks outside of their phone. But we know that in the UK and all over Europe, certainly people are launching digital banks. If you go to the US, on a separate stack, right? That's the important part, is that you're not on the legacy systems. If we go to the US, JP Morgan's the one to talk about. So JP Morgan recently launched Fin, which is a mobile-first bank. And so when I look at things like that, I do have hope that the APIs and the infrastructure can be opened up and made available to other third parties. I do think there's definitely value to that. But then on the other hand, going back to someone like JP Morgan, they're launching the neobank, and at the same time they're also coming out with a robo-advisor and a Robinhood competitor. So and they're pricing all that stuff at zero. So if you're asking what is the intention of a JP Morgan in relation to letting there be oxygen for startups, the answer is they're going to price your product at zero, give it away for free until you run out of venture funding. So it's not an easy environment in which to play, but I think the very shrewd operators could get there.
No, but it's one of those kind of challenging situations in which everyone wants open, rich, fully functional APIs, basically, so they can consume from each other. But no one has much of an incentive to make theirs particularly open and rich and start giving their user data away.
Yeah, but I mean, you look at something like you look at Google. Going back to it, Google Maps API is available for free for anybody to build on. And there's a ton of other web services, all the way, from trivial stuff all the way through to real machine learning, the core machine learning libraries that Google runs for their own products. A bunch of those are open source, and a bunch of those you can get as a service. So you could definitely say that's a competitive advantage they're giving away. But I think with tech, the more open you are and the more you build with the community, the more there's a virtuous cycle of everything becoming more digital. Whereas I don't think the finance world's in a place where they really want everything to be more digital. I mean, if you own a magnificent cash cow, you probably don't want it to melt as fast as possible. But for folks like JPM, in the case of the free trading and the free robo-advisor, they'll certainly be open to cutting off a limb if it makes the overall company sustain for longer.
Switching gears completely, you guys at Autonomous Next published a report recently called Crypto Utopia. And I imagine a lot of thinking and many man-hours of research went into that. would highly encourage everyone to check it out, read it for themselves. But given that we're sitting here with you, highlights, key takeaways, things people should keep in mind as they link to it.
Ooh, that's a tough one. It's a short read, 126 pages, just a breeze of crypto research. So it's definitely for people who have a passion, who are committed to the space. And there are a couple of data points, high level, that just show the direction of where we are. And I think a rigorous treatment of it is important at a moment when the SEC has just turned down, I think, 9 different Bitcoin ETF applications. They said too much market manipulation in the underlying asset. It's important at a moment when the key platform on which everyone is launching tokens and building has fallen, I think, 80% in value since the beginning of the year, Ethereum. So, what's left? Why do we even care about crypto and blockchain? And once you start digging into it, there are a lot of satisfying things to be excited about. And for me, at least, I'm excited about the crypto ecosystem and the people that are working in it and the companies that are being built there, in the same way that I was excited about fintech in 2009, where it's super early. The large money has not come in. There's a lot of skepticism about, why would you do this when we already have this, which is exactly what we heard with fintech. And there hasn't yet been this kind of co-opting of the disintermediation opportunity, right? It's not that every single investment bank is issuing their own currency, which I'll talk to you in 10 years, but I'm sure there's a lot of people who would buy some Goldman coin. So the key pieces, first off, if you think about ICOs and the token offerings over the last year, let me put it into context. So venture capital in fintech is about 20 billion per year. In 2012, it was about 4 billion. So big move, right? IPOs for financial services and insurance companies globally, about 40 billion per year as well, right? So that's the level. Coin offerings, the year in 2016, I don't remember off the top of my head, but I would say about 250 million, maybe even less. In 2017, that number was 7 billion out of nowhere. And this year, we're probably already 15 billion in, right? So cumulative, over 20 billion raised in tokens, or rather for tokens in other currencies within the last year and a half. You can say it's magic beans and it's fake money and all this stuff is a scam and a fraud, and you would be 95% correct and 5% dead wrong, right? Which is how black swan events happen. So for me, I think there's this outsider piece around it that's really compelling. People are in it for passion and for reasons that have to do with the why rather than the how. And there's certainly plenty of capital in the space that's helping people build weird stuff. And there's thousands now of startups that have been formed behind that 20 billion to make some really interesting software. And again, most of it will die, burn up, and that's what should happen, and that's fair. So that's one data point. Data point number 2 is there is 370 crypto funds. Probably 80% of those were formed last year that manage 10 billion in assets to invest in this space and in this space alone. So all the pushback of what's Bitcoin really worth and how do you value it, or why would you buy a token and not an equity? These are really great sort of arguments to have with your family on Thanksgiving. but it doesn't matter because people are doing it and putting money to work and investing in it. And the people that are putting the money to work are smart and capable and have had reasonable careers. Insofar as you think Wall Street people are smart, there are a lot of smart people in crypto trying to invest in it and make sense. So, these are kind of two anchors. And the third thing that we see is regulatory maturity is coming. So it's not there yet, right? The SEC is pushing back on some things, saying okay to other things, but there are now things called security tokens that are being pushed out. There are institutional custodians that are figuring out how to manage crypto assets. There are all sorts of new types of exchanges and new types of software that's meant to create liquidity between existing exchanges. And so it's starting to look like an asset class. And that's, I think, the main takeaway that many people have come to. But the main takeaway is that this is now a slice of an asset allocation. It's not just, a burn the Fed type of bet.
And that plays out through buy some Bitcoin or invest in a crypto fund who's, supporting infrastructure builders. How do you get exposure to this? What's the best way?
Oh, that's a question that would get me into so much trouble. Here's what you should not do. You should not go to a digital lender, mortgage your house, and invest all of it into an ICO. That would be a bad idea. A lot of people did that actually at the end of last year, and the New York Times is now gleefully covering all the money that people have lost and have had their lives ruined. But that's the same thing if you had gone out and tried to invest in a seed stage company and put 10 times your life savings into it, or if you bought a penny stock and levered it up to the max, you have the same outcome. So kind of three pieces of guidance, which I think are just prudence. The first is asset allocation. So always look at what you hold in the terms of asset allocation. Probably 85% of what you hold is in what's called a core portfolio, and that's a super boring pie chart that you get from Betterment or Nutmeg. That's it. Don't futz around. That's the thing. Outside of your core, you'll probably, if you're the Harvard endowment, you would have a 15% slug in private equity and hedge funds, right? So it's venture, private equity. You might be holding some uranium futures, all the weird stuff. So that's where your Bitcoin sits, right next to the sludge on a train. So how big is that? Call it 1 to 5% of your overall net worth, right? And kind of be honest with yourself, because in the net worth you have to subtract the things you owe, right? So it's probably, this is why people don't like finance. It makes them feel bad.
Most people would probably stop listening to this episode by now.
That's my fault. So in that 1 to 5%, you have the room to play with crypto. And when you look at your crypto portfolio, the same logic applies, which is you want to diversify the core of your crypto portfolio, which will be the large cap holdings, which are Bitcoin, Ethereum, and whichever others you decide to believe in for philosophical reasons. And then there's probably a little bit of picking favorites if you so choose. And one of the things about crypto that's, I think, beautiful is that you don't need to be an accredited investor in order to put $200 into what is essentially an early stage gamble. So for a millionaire, you would do that, but now you can do that as a retail investor. It's just you have to be smart in terms of how much that goes in.
Well, excellent advice. Where can people find the report?
Easy enough. Next.autonomous.com, and it will just be under the crypto themes from the top.
Great. Lex Sokolin of Autonomous Next, thank you very much for joining us.
Thanks for having me.
Thanks for tuning into Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.